Hi, this is Tony Daly, and today we're going to look at the Options Express platform, and I'm going to give you a quick rundown of some of the ways we can pick our short strikes to build our credit spreads. This will particularly help my mentoring students who we've been working with the two platforms, Options Express and Thinkorswim. And today we're going to look at the Options Express side of things. So anyway, for purposes of this little example here, we're going to look at the IWM, which is the ETF for the Russell 2000. And the reason I picked the IWM is because it mimics the Russell. It is basically the Russell 2000. It has dollar-wide strikes. It's extremely liquid, and you can have a lot of success with this underlying here, because basically you're well diversified because you have 2,000 stocks worth of diversification, which is quite adequate. So anyway, let's take a look at the December. This is the December expiration, and here are our deltas. And one of the things we're going to do is we're going to start out by pulling out. We're going to do a pretty conservative trade, and we're going to look at about one standard deviation out. Now, one standard deviation out is basically a delta of 16 on the call side and on the put side. So 16 and 16 is 32, and one standard deviation is 68, which equals 100%. So looking at the put side, where we don't have a 16, but we have a 17 and we have a 14. So let's select the 17. And looking at the bid and the ask, we're looking at it somewhere between 53 and 57 cents. So here we would be collecting the 53 cents. Let's cover ourselves by going $2 down. And basically the premium we're going to collect is going to be offset by our max risk of 105 to 107, or $2. So $2 is $200 less the premium we collect. So let's just take a quick look at that. Okay, remember this expires December 20th, and we're looking at collecting 10% or $20. So you could see we're risking 180 to make 20, or just 10% between now and December, and we have a good chance of that happening based on the probabilities. So this is what the trade page would look like, and here is the risk graph. And now let's go to the probability chart. So the probability chart gives you different targets, and it also gives you the standard deviations. So if you just wanted to look and see what the standard deviations were, we can see that one standard deviation, or 68%, would be between 107 on the put side and 116 on the call side. Two standard deviations represents 95%, would be 103.42 on the puts and 120.95 on the calls. And then of course going all the way out to three standard deviations, which represents 98%, would be 125 and 99. So just sticking in this range right here, most people, depending on how aggressive or conservative you would be somewhere between 1 and 2 standard deviations. And we would do that monthly. And we would also diversify. So we know that we've already done the calls. Notice we are right on the money with the 107. We're going to look somewhere around 116 for our call side, and here is 116, 117. Here's our standard deviation. At 116, it's a 16 delta, which is perfect. So we're going to sell that. We're going to buy that. Now, let me just make you understand. The delta is 16, which means there's an 84% chance that price will be below 116. I'm sorry, 1 second. We're gonna go right here and do that. Here we are. It's at 15 delta. So we're going to sell that, and we're going to buy that. Still the 116. And what we're doing is remember, so our short strikes are going to be here at 116 on the call side, and here at 107 on the put side. So we're basically looking for price to stay within 107 to 116 between now and the third Friday in December. The reason we're buying is basically this is our protection right here. So if it does go out of the money, we don't have any responsibility below 105. So we have $200 worth of risk less the total premium collected. And the nice thing about Iron Condors is you collect two premiums, but you can't be wrong twice. Okay? The other thing you could do is by just hovering over the detail, we can go to the probability, and you can see right here everything you need to know is right here. Probability of touching, probability of expiring below, and probability of expiring above. So we're really interested on the call side of it expiring below, and we have an 85% chance of that happening. If we go right, hover over the detail, go to probability, same thing. Probability expiring above, 80%. So we've got some really good probabilities on our side. So this is very good. Here are your Greeks, which show the deltas, the implied volatilities, and the theta. And you recall what the theta was. The theta was the decline or premium erosion every day. So you see that you can do it a couple of different ways. So now if we put it all together and run through the trade calculator, let's see what we have. So what we have is now we're going to collect $37 because we're collecting two premiums. It represents 18.5% for 1 month, and we're risking $163. Now, depending on your level of how aggressive you want to be on this trade, if one were to do 10 contracts, and we were just looking at the market price there, oops, that was 100. Sorry about that. Let's do it again. We don't want that. Okay. Now we'll get it. Okay, there you go. You can see we're going to collect $370, and our risk is $1,630. Now, you saw the odds that we have of that not happening, but there's always risk in any type of options trade, and we see our break-evens are 106.33 and 116.37. So what we'll need to do after we put this trade on is quite simply just manage it. You would have to have $1,630 in your brokerage account to put this trade on, and you're going to collect $370. So our low strikes are 116 and 107. We can go to our probability chart, go to the target calculator, and put in our lowest target of 107. We could put in our upper target of 116, hit our calculate, and we could see that with 107 and 116, there's a 12% chance of it expiring below and a 17.56 chance of it expiring above. Those would be our undesirable things to happen, but we have probably right around that one standard deviation, don't we? It looks like we're right around 70% chance of this being a successful trade. So that's how you put the math on your side, and that's your risk-reward ratio. We see that the theta, position theta, is $14.23. That's how much money we're going to gain every day. So we will gain $14.23 just by regular premium erosion. Remember, if you are the buyer of an option, this is money that it would cost you. But when we're premium sellers, this is money that we get to keep. The Vega represents the amount of money that the option premium will change based on a 1% change in implied volatility. Gamma is the acceleration of the delta, or the rate of change of delta. We'll talk about that another time. But here the deltas, we're showing a net of minus 23 deltas, so which is consistent with a credit spread. So Our spread is between 35 and 46, which is an 11-cent spread. And I would attempt to try to put this trade on right around 40 cents. I think we can get 40 cents for this trade. So the bottom line would be, and here is the bottom line. The bottom line is we will collect $400. Our risk is $1,600. This is a 25% trade. This would be the commissions that it would cost us to put on this trade. And basically, here's our risk graph. We would want it to be in between 106, our low and high strikes, which would be 107 on the put side and 116 on the call side. So that's how we do it. There we would just hit trade now, and we would be putting this trade in, and away we go. So that's it. Hope this helped. If you have any questions, you can give me a shout out or email me at tdally@bellsouth.net, and I will see you next time. Thank you. Bye.